We are now going to cover accrued expenses and accrued revenues. The previous two, the deferred expenses and the deferred revenues, is when the cash came first. So with the deferred expenses, we paid for something before using it. With the deferred revenue, it was our clients paid us before we actually performed the service. The accrued expenses and accrued revenues are the exact opposite. This is where the cash comes later. We are covering accrued expenses in this video, and that means we use something up before we paid for it. So we're probably going to get a bill or something. Now, the important thing to note here in adjusting entries is we have to make sure that it hasn't been recorded before. So typically when we receive a bill, we would put it into the accounting system. What we're doing in these adjusting entries is we are going through all of the accounts and saying, hey, did we get everything? And there might be something in there where we say, hey, we haven't actually recorded this yet, so we need to do it now, show that we owe this person. There's a couple of different things that a couple of different examples that we can use. So the first one I'm going to use is advertising. And I do this in my own business where I do like social media advertising and the bill comes later, right? So I might not get actually billed for a couple of months or, later than when I'm actually putting together the financial statements. So, for example, I might know that I owe $50 in advertising, but I have not received the bill. Now, why is that important? Again, because typically when we receive the bill, we put it in the accounting system right away, and so it's already there. We don't want to double up things. So we're just looking for things that we haven't put in yet. So in this case, I know that I have spent $50 for advertising, but I didn't get a bill yet, so I'm going through the accounts and saying, hey, something is missing here. So I know that I owe this advertising. Even if I haven't received a bill, I use the services, so I technically owe this $50. All right, so the debit here would be, since I used something up, it would be an expense. So I would go advertising expense. $50. So I would debit advertising expense. The credit here is, since I owe this money, it's going to be some sort of liability. In this case, I'm just going to throw it in accounts payable. You could make a new account called advertising payable. Every business is going to be a little different in that respect in what they call the accounts and how many accounts they have. In this case, I'm just going to put it in accounts payable. But this is going to be the pattern for all of these accrued expenses. We have used something up and we now owe money. So we are going to debit some sort of expense and credit some sort of liability. All right, the next example is the one that is most often used in the homework, and that has to do with paying our employees. Now, in a typical business, employees do work first and then they get paid later. There's not very many instances where the employees will get paid first and then they do the work. So typically the employees do the work and then you count up your hours and then you get paid later. So this is often used. And usually all of this is entered in the accounting system when the employees are paid. So when you do payroll, you do all the calculations, figure out how much you owe the employees and so on. And that can be a week or two later after the work is actually done. So if you're getting paid bi-weekly, you do work for 2 weeks, and then you have to wait a week to get that paycheck for the work that you did. So there can be a significant delay. And so this comes into play when we are at the end of a period, for example, the end of a year, and we're going through our accounts on the trial balance and saying, hey, do we have everything that we owe everybody here? And we look at this and say, hey, didn't our employees work? We now owe our employees for that work. We're not paying them for a week, but we need to make sure we update our accounts to show that we owe them this money. So you might see a problem that says we pay our employees, let's say, on average $3,000 per week. And they work 5 days a week. And we pay them weekly. So we get down to the end of the year and we say December 31st was a Wednesday. To make sure our accounts are complete and updated, we have the 29th, the 30th, the 31st, the 1st, and the 2nd. So 1st and 2nd are January, 29th through the 31st are December. Here's our cutoff. We are trying to make our balance sheet and our income statement as of December 31st. So here's the trick. We need to make sure we include everything for these 3 days, the 29th through the 31st. That has to be included on the financial statements, but we cannot include anything on the 1st or the 2nd. And we would probably be paying our employees on the 2nd or maybe sometime the next week. So we have to be careful that, we haven't recorded that we paid the employees or we owe them, in which we probably haven't, and we need to make sure we have this cutoff. All right, so one way we can do this is we say, well, how much are we paying our employees per day? And so if it's $3,000 per week, and there's 5 working days per week, $3,000 divided by 5 days per week is $600 per day. All right, so we have 3 days, and that would be $1,800. And in the pattern that we did before, we have used up our employees' time. We can't get their time back for them, so that's an expense. Let's call it wages expense in this case. Sometimes you'll see it salaries expense, employee expense. Again, the actual name doesn't matter as much as it's an expense. So we have $1,800 there. And the credit, since we owe this money, that's a liability. And often you could put this in accounts payable, but most often we'll see something like wages payable or salaries payable. We actually separate it from the accounts payable part. All right. So there's our adjusting entry. There's one more thing that I want to point out here is now when we actually pay our employees on the 2nd, this is not an adjusting entry. This is when we actually pay them on the 2nd. We pay them $3,000 in cash, so we would have to credit cash $3,000. Now, part of this $3,000 is paying off what we owed them before, this $1,800. So we would actually debit wages payable, $1,800, and the other $1,200 goes to wages expense. Now, the whole purpose behind this is we need to make sure the expense is in the correct period or in the correct year. This $1,800, we said, that belongs in December, because that is when we used it. This expense over here, we say, belongs in January because, again, that is when we used the employee's time. So just be careful that you're not doubling up on expenses and making sure that the expenses are in the correct period when you're doing these. For this chapter, the most important thing is knowing how to do this adjusting entry over here, but you also need to be aware that when you are doing the journal entry in the future, you are making sure you are not doubling up on the expenses.